The investment world is becoming more and more diverse every year, and the instruments of the financial market are more and more attractive. The modern investor has the opportunity to invest their funds not only based on profitability and risk, but also on the basis of their moral and ethical principles and religious beliefs. Today, Islamic investments have become widespread, which are based on the strict moral and ethical standards of the Sharia. The main difference between Islamic investment and classical investment is the denial of income through investing in speculative instruments. The priority area in Islamic investments is the real sector of the economy. According to Islamic principles of investment, investments in companies whose main activities are at variance with the basic principles of Islam are considered unacceptable, including the production or sale of alcohol, interest-based financial services, the production of pork and pork products, the organization of gambling and the implementation of speculative activities. According to Islamic principles of investment, investments in bonds are prohibited because they are classified as debt securities on an interest rate basis, investments in stocks of companies with a high proportion of leveraged funds, investments in mutual funds or hedge funds that trade securities, because trading considered by some Islamic scholars as a type of gambling. Investments in derivative securities such as forwards, options and futures, etc. are also prohibited. In this case, the question arises, where can the investor invest his savings? Or what alternative can the Islamic financial market offer? Today, the range of offers of the Islamic financial market is represented by the several investment instruments. For an investor not familiar with the norms of the Islamic market, these concepts are far from understanding. But, despite their specific names, these instruments are simply some kind of substitutes for traditional financial instruments. Take ijara, for example, which is essentially the same leasing. Takaful is one of the types of insurance that is widely used in Muslim countries. However, a distinctive feature of Islamic investment instruments is the absence of interest and debt character. The Islamic securities market is characterized by its own special investment instruments, the most widespread and most frequently used of which are securities referred to as sukuk. A feature of sukuk is their provision with a real share in the allocated material assets of the enterprise or shares in the financed project. The sukuk market today shows positive growth dynamics, which indicates an increase in investor interest.
Cambridge Islamic Finance Access Program, organized by Cambridge Institute of Islamic Finance, offers individual practitioners and Islamic financial institutions like Islamic banks, Islamic asset management companies, takaful providers, and educators a unique training program for professional development of its employees. Third module of Cambridge Islamic Finance Access Program, on structuring Islamic investment products, offers its participants to get familiar with popular Islamic investment products and their structures, highlighting Sharia issues in the process. It is also intended to highlight the importance of developing cutting-edge Islamic investment products to improve depth and width of Islamic finance, with an objective to emphasize upon the importance of investments, and clarify differences between financing and investing. After having studied this module, the participants must be able to understand differences between Islamic investments and Islamic financing products. The participants must also be able to develop skills to start specializing in Islamic financial innovation and Sharia-compliant product development. The baseline outcome of this module is sufficiently adequate understanding of Sharia screening of stocks and listed securities.